the week is treating you extremely well. Mike Tedeschi over at Perspective Wealth Planning. In this week's video, we're going to take a look at the 4 major U.S. indexes. We're also going to take a look at breadth readings, and we're going to take a look at some data sets as well. So let's jump right into it here this morning, guys. First off, we are opening at new all-time highs. The market had a sharp sell-off on coronavirus fears, fell right to, here's your blue moving average, the 50-day moving average, where it found support. That's the zone where we like seeing the market find support on the first pullback. And subsequently, we have sprung higher off of that. So really good price action thus far for the bulls. Again, when we take a look at the overall market and back this out onto a weekly or monthly chart, we can see that we had a major breakout at the end of last year and are continuing to rock and roll higher. On a weekly chart, we held the 10-week moving average, which is a very good sign. All the moving averages are aligned. The 10 is over the 20, it's over the 50. Technically, everything does look pretty solid at this point. It doesn't make a difference which index you look at, except for the Russell, and we'll get to that in a second. They're all very similar. The Nasdaq opened up and actually made new highs a couple of days ago. It continued to push higher above its 10, 20. Didn't even come close to testing the 50. So strongest of the sectors from an index perspective at this point. Dow Jones broke the 50-day moving average, but did hold, and this is what's key here, this previous support level right there at that 28,000 zone. And so we're going to watch for it to continue to push up over 29,400 here for that follow through. But again, breakout, back test, breakout, back test. Market is acting extremely well here. We come in and take a look at the Russell 2000 at this point, still off of those all-time highs. We put that 1710 level on the Russell chart a long time ago. We came up, we pretty much tagged it exactly. And look where we pulled back to here. We pulled back to that key 1620 zone that we've been talking about for quite some time. Pretty much throughout all of last year, we talked about that as the major level to break back above. So runs into resistance, falls back to support, makes a sharp bounce. We're still watching that battleground in on the Russell up here as we move forward here over the next couple of sessions. Now, when we take a look at the emerging markets here, strong breakout, fell below some key levels and subsequently have rallied back up above them. That 11,000 zone is what I am paying the most attention to. We fell way below it on the coronavirus fears and then immediately rocketed back up higher. And on this chart, I want to throw that 200-day moving average up there for you guys. That is that purple moving average that you see right here. Came back, bounced before it got to the 200-day moving average, fell cleanly under the 50-day moving average, but again, sharp, solid bounce back to the upside. So pretty solid action there. Really, the key thing I want to take a look at here this week is a lot of those sentiment figures that we've been taking a look at have come back down into a more normalized range. So that sharp, quick pullback that we had off of the coronavirus fears, that subsequently has set a lot of these overbought, ridiculously extreme sentiment readings back into normal zones. So again, we've talked about this a lot, how it will come back down towards that middle. And as stretched as it was, we had that sharp, quick sell-off right there on the S&P, and that subsequently has brought a lot of these readings back into a more normalized range. And that is really, really important for us to be able to continue to see the market push higher. We need those sentiment readings to come back down more into those normalized areas versus being extremely stretched for a long period of time. The longer it stayed extremely stretched, the more risk essentially there was. As we've come back down towards more normalized levels, again, that gives us the ability to kind of continue to rock and roll high. We have talked a lot about the Nasdaq McClellan Summation Index. This fell back down, and if you remember the last time that we took a look at it, this major important level right around this 200 zone, right? We broke out, we ran up into this resistance zone, and subsequently took that sharp dive lower. And that was, of course, the concern was how far that breadth reading fell. And if we had broken underneath of this zone right here and continued to fall, there really wasn't anything till we got back down here, which would mean we were in for a pretty steep sell-off. but we have currently abated that and have stopped falling, and breadth readings are starting to turn back up right here, right? We're not out of the woods, so to speak, here. A couple of days to the upside didn't necessarily fix that completely, but it looks like when we zoom in here that we're starting to have that turn. So once again, we could be headed for that tailwind, so to speak, for the breadth reading. So we're going to continue to pay very close attention to it, but it has acted pretty much exactly as we've expected here for quite some time. We've laid out these major levels of resistance, and they have acted extremely well so far. The last data set that I want to look at here today, I want you guys to take with there's only 4 current readings, so it's not a lot from this historical data standpoint. But what we're looking at is the market gapping up for 3 days in a row, greater than 25%, and making a new high. It's really only happened 4 times in the past. One of them marked that big top back in 2018, and the rest of them all saw positive movement for quite some time. Right. The reason that's important, pull up a chart of the S&P 500. These gaps typically at the end of a move can be exhaustion gaps. We had a couple of 1% overnight gaps over and over again, and that is a little bit of a concern. However, again, when we look at the rest of the technicals on this, everything else is fine. It's just those sharp gap moves higher really show and can show buying exhaustion, so to speak, when you get gap after gap after gap at highs after you've already had a long move up. When gaps are really good is usually at a reversal standpoint, meaning if the market's been falling for a long time and all of a sudden positive news comes out and it gaps up overnight, that ends up being a positive thing. And a lot of times you will see the market continue to push higher off of those gaps. And sometimes they don't even necessarily fill those gaps, so to speak. But when you have a long move here to the upside and then you have gap after gap after gap, it's a bit of a concern. And again, we only have 4 data sets. 3 of them, everything was very positive. 1 of them was very negative. And the one that was very negative was the one that's in most recent memory. If we come back in here, we had gap after gap after gap right back up in this zone. And then, we all remember that sharp sell-off that we had at the beginning of the year. The market fixed itself pretty quickly after it fell in that 200-day moving average and made a sharp bounce. But again, after a long move to the upside, when you get gap after gap after gap, it's a little bit of a concern. That's really, of all the things that we took a look at here today, the only thing that I really see here that is very concerning. Everything else, good, solid price action. Again, we hit that 50-day moving average. We bounced off of it. We've gone and made new highs. All the moving averages are aligned properly. Most of the indexes are all at all-time highs. The Russell, of course, has lagged, but it's lagged now for 2 years. And again, maybe that's not as important as it once was. We would like to see it make a new all-time high so that we can have that full, market making all the indexes making new highs. That would be very bullish, but currently as it sits, that's not where we're at, but it doesn't mean that we can't continue to push higher on the rest of the indexes. As always, I hope these videos are useful and helpful for you guys. If you have any questions, you can reach out to me directly. You can shoot me an email at mtedeschi@perspectivewealthplanning.com or give me a call at the office at 814-580-9881. I hope you guys have yourself a fantastic week. As always, I'll see you next week. Take care.